Welcome to Share Talk, the only podcast where investors come first.
Hi, this is Zak Mir with the Bulletin Board Heroes here on Share Talk for Tuesday, the 8th of September. Starting with Arix Bioscience, where difficult to resist the stock, given the gap through the 50-day moving average currently at 82 pence, also cleared the 200-day moving average at 87 pence. While we're above the 200-day line on an end-of-day close basis, mid-price looking for the top of that rising trend channel from January, as high as £1.25, but obviously juicy fundamentals from the company reported today. On to Cyanode, which gets occasional airing here on the Heroes. Here you can see that we had a gap higher yesterday through 4.5 pence. Also broke that resistance line there from July, which looks quite encouraging. Probably slightly high. That's the exact place there. So around 4.6 pence. While we're above 4.6, looking for reasonable or considerable upside. Actually, the top of a wide rising trend channel in place on the daily chart from as long ago as July last year, and that's pointing towards the 10 pence area, and that could hopefully be hit over the next 1 to 2 months. The plus points here are, apart from the latest gap yesterday, we had a gap through the 200-day moving average, which is normally significant, especially as it was after a bear trap as well, back below a penny and a half. And we've also had these higher support points for the stock above a now rising 200-day line. So that does suggest that we are very much in bull mode for Cyanode. Chariot is next, and it has its fans. Here you can see that the shares have actually managed to spike up well above the initial target here, which was the March resistance line there at around 2.9 pence. End of day close above that particular line could open up the prospect of a retest of today's intraday peak around 3.9 pence and point us in the direction of a December resistance line projection, currently up to 4.5 pence plus. Obviously, that's retesting, I suppose, 1 year resistance, 1 year highs above that level. So the lines and the chart price action adding up quite well. Got a couple of stocks here which they don't have actually, which have very little historical data, so it's a little bit of a creative thing that we're doing at the moment here. As far as Corcel is concerned, the big highlight here was yesterday's end of day close above the that line of resistance from August, and really while we're above 1.3 pence, looking for an estimated upside there up to 2 pence plus. That's the estimate of how wide the trend channel is. Let's see if that particular bit of guesswork works well, but at least above 1.3 pence we are looking for further upside. Ideally, there's a pretty swift end of day close above 1.4 pence, which was the August peak, over the next few days, or maybe a weekly close on Friday for Corcel. Another stock, as I said, with very little charting furniture at the moment is Drums, which has got people excited because it's got an interesting epic code. This is a similar setup to Corcel in the sense that we've just broken near-term resistance line. In this case, it's at 0.8 pence, and about 0.8 pence, the guess here is that we'd head up to 1.2 pence, which is a July resistance line projection. I'm not quite sure exactly where that would be, but around 1.2 pence looks as though that would work, and obviously that would be a decent upside for those fans of the shares. Only really back below 0.7 pence, that uptrend line from July really killing the recovery argument or the bull argument for Drums at the moment. Gunsynd, also a popular stock at the moment, and here we've had a bit of a battle here either side of the 200-day moving average. That's currently at 0.85, and that's been the sort of the midpoint of the range for the last month or so. We obviously had that spike towards 1.2 pence, but the view here is that it looks as though with multiple tests of the 50-day line at 0.78, the shares are finally on their way, even though they are rather slow at the moment. and at least while we remain above the 50-day line, still looking for the long-awaited 1.8 target at the top of that rising trend channel from way back at, I suppose it's the tail end of last year. If you're cautious on the stock, I suppose an end-of-day close above a penny would be the trigger point for assuming that the shares would go up and stay up. Onto a stock which has not been so reticent, and that is Kefi. Very nice price action of late for the shares, belatedly, let's say, and we've hit the initial target there, which was around 2.7, 2.8, let's call it. End of day close above 2.8 would hopefully open up the prospect of a new leg to the upside, in this case up to the line of resistance from July last year, currently pointing at 4.4. But as is usually the case in these situations, a bit of consolidation may be required around the 2.5 pence zone to 2.8 pence zone before we see a new leg to the upside. But at least above 2.5, one would have thought and one would expect the shares to push on higher after a brief pause. ODX, Omega Diagnostics, is next, and I suppose the story here is when the shares will finally be able to break 70 pence, which seems to become a bit of a block on the price action. I suppose it's interesting to note the way that May resistance line has already been broken at, 62 pence, let's say. And so if you are keen on the stock, while there is no end-of-day close back below 62, we're looking for further upside and assuming that 70 pence will be broken. And for those keen people on Omega, the top of that trend channel from April at just over £1 would be the target over the next month to 6 weeks. But I suppose the obvious thing here to do is to wait for an end-of-day close through 70 pence, or at least even an intraday close, intraday push through 70 pence, which has so far eluded us. On to a stock which I was meaning to cover yesterday, but was so overwhelmed with the birthday situation that I've managed to forget it. Here we've got equatorial palm oil. And here we've broken the initial target here, which was 1.2 pence, so that January resistance line at the top of the broadening triangle from the beginning of the year. So that the story here is that really while we're above 1.1 pence on an end-of-day close basis, we're looking for a fresh leg to the upside. Obviously, this would be a bonus after the great gains we've already seen, but there's a line of resistance from the beginning of 2019 currently pointing at 2.7 pence, so above the 1.1 pence area, 2.7 could be the next target for equatorial palm, and we've seen the way the shares have previously spiked up from or through this area, the 1 to 2 pence area, so hopefully history will repeat itself again. Next stock is one that is not normally in the pay grade of the Bulletin Board Heroes. It's a bit too big and a bit too slow, but it has been requested by an eminent person on Twitter, and the view here is that while we, as we've broken that line of resistance from June, running through towards the 42 pence area, while we're above that, then we are looking for an imminent move towards 60 pence, which is post-July resistance, and the best case scenario target here is a move back up to £1 for Stagecoach shares over the next, let's say, 2 to 3 months. Obviously, any end-of-day close back below 40 pence would rather ruin or delay the upside scenario. If you want to be safe, probably at this stage, the safest thing would be to wait for a clearance of the 50-day moving average. That's falling there around the 49 pence area, or perhaps a bit quicker would be a break of the RSI back above neutral 50 versus 45 at the moment. A couple of stocks to go. Probably the dish of the day is ScanCell, which I think I covered recently, but can't quite remember because obviously I look at so many stocks. But the highlight here really was, a couple of highlights. First was the break in mid-July of that resistance line from April. And the second highlight at the end of last month, the as yet unfilled gap to the upside through resistance, which I can't believe I didn't cover at the time. Initial target here up to 12 pence, which is that December resistance line projection. But the way things are going, I would expect a blow-off move or blow-up move, maybe even, up to 16 pence, 17 pence, which is the top of the broader triangle there from November 2018. And so an end-of-day close through 12 pence, really the sign that 17 pence could be on its way. At this stage, only back below, an end-of-day close back below 10 pence, which was July, post-July 2019 resistance, really delaying the upside scenario. But with that gap there through the resistance, I wouldn't expect too much of a pullback, even though with the RSI at 87, we are rather overcooked at the moment, technically. Finishing off with Zanega, and here you can see that the stock is trying tentatively to build a base here. It looks like it's already done it with that, I think with that particular green candle there from the 2nd of September, which was a sort of bear trap attempt. We've come back quite well after that. Now we're breaking with a hammer type candle, the 50-day moving average at 6.2 pence. End of day close above 6.2, and the 50-day line should be enough now to set the shares on their way up towards that top of that mini price channel from June up to 10 pence over the next, let's say, 4 weeks. Big figure target here, if we get off the ground nicely, would be back to 14 pence, say, on a 2 to 3 month view, or a 2 month view, which is that September 2019 resistance line projection. But at the moment, basically above 6, looking for 10 pence on Zanega. That's it for me today. More updates tomorrow.
Thank you for listening. Remember to visit our website for more news and other podcasts at www.share-talk.com.